This year, I made £16,785 just from investing into the stock market. And today I'm going to share with you guys a 4-step plan that will allow you to build an investment portfolio that brings you profit in 2024. Now, I'm not saying that this is going to be easy. My trading 2-on-2 portfolio actually at the start of the year was down in the red £5,786. But from taking very calculated decisions throughout the course of the year, now both my trading 2-on-2 and Vanguard UK portfolio are at all-time highs, with my Vanguard portfolio being up nearly 100%. So if you're looking at achieving similar results from your portfolio, then be sure to stick around till the end. And whilst you're over here, be sure to subscribe to the channel if you want to grow your wealth too. And with that being said, let's kick off with stage number 1, which is evaluating your current situation and goals. As we approach the end of the year and begin a new one, now is a great time to sit back and reflect on what our financial goals are and aspirations are for the future. It's important to make sure that we have a clear and well-defined path between where we are now versus where we want to be. This is the point that you ask yourself why you want to invest and what you're investing for. Is it retirement? Is it to buy your first home? Is it funding education or something else? Be sure to let me know what your financial goals and aspirations are down in the comment section below. Now, goal setting is one thing, but going on to achieve those goals in a way that's comfortable for you is a whole different topic. This is where it's absolutely imperative that you understand your risk tolerance. At the low end of the risk spectrum, you've got the cash hoarder, and at the high risk end, you've got the crypto investor. There are a whole load of variables and investment options that provide all different rates of return in between. So it's important to understand where your risk tolerance lies, because that will dictate a super important aspect of your investment portfolio, which is your asset allocation. But more on that in just a moment's time. First, we need to discuss the time horizon that you have for your investments, because this will largely dictate how conservative or aggressive that you need to be with your investment strategy. The rule of thumb here is that the longer you have, the easier it becomes. A £10,000 investment compounded at an 8% rate of return per year with £1,000 in monthly additions over 5 years will be worth £88,375. But £10,000 compounded at the same rates for 40 years is £3.7 million. So in an ideal world, you'll let the power of time, value and returns do the work for you to achieve your financial goals. So write down what those goals are now and then reverse engineer them to calculate how much you need to invest, what those returns need to be, and how long you need to get those returns for in order to achieve that goal. Now, as part of achieving those goals, as I said, one really important point to consider is stage 2 of the plan, which is your asset allocation. This is how investors divide up their investment portfolio among different assets based on your risk tolerance, time horizon, and financial goals. Here is the asset allocation of my own personal investment portfolio, excluding my pension. I've got a 32% allocation to an investment property I own, 39% in individual stocks, 25% in our diversified ETF, and 4% in cryptocurrency. Now, that's what I deem to be a well-balanced portfolio based on my own personal risk appetite. And what you need to do is kind of identify what that kind of healthy middle ground is for you based on your own personal circumstances. It should be a case where you can still sleep well at night and don't run the risk of blowing out your investment account.
It went to zero!
Now, there are 2 types of asset allocation strategies that it's worthwhile being aware of. The first one being strategic asset allocation. This is where you invest in a fund or have a portfolio with a static asset allocation mix. An example of this could be something like the Vanguard Life Strategy Fund, which is split between 80% in equities and 20% in bonds. This is kind of akin to your typical buy and hold investment strategy. You pick an individual fund or just a selection of investments, and then you stick with those investments come rain or shine. It's a strategy that I largely follow in order to help keep things simple, because investing can be complicated at the best of times. The second strategy is the tactical asset allocation. This is a strategy that ensures when market conditions create opportunities to get additional returns, you can be flexible in your approach to capitalize on them. Now, admittedly, a strategy of market timing is a little bit more difficult to execute on. A recent study done by JP Morgan shows that if you'd missed just the best 30 days of performance of the S&P 500 this year, your returns would have gone from 19% to negative 23%. So staying the course and not chopping and changing your investments, unless you're some kind of whiz fund manager, is probably sensible. But certainly want to know for any of you investment whizzes out there. Now, stage of life can come into play here too, because at some point in time, you're probably going to want to make changes to your portfolio. And that's because the younger you are, the more risks that you can take. Now, and I don't mean just go all in on crypto, because that would be stupid. Instead, I mean kind of having calculated exposure to different asset classes to maximize your upside, but in a controlled manner. Because as you get older, you want your portfolio to have compounded well and almost kind of matured, meaning that you can kind of transition then into lower volatile asset classes. Because even the global markets are volatile in themselves. The S&P 500 is up 23% year to date, but in 2022, it was down 19.5%. So as you get older, you're probably going to want to move some of your investments into more stable investments like money market funds, or even just holding cash in a high interest rate savings account, because that's likely going to be an asset allocation that you're a little bit more comfortable with. Here is a chart that reflects what I'm trying to say, where the older you become, the lower your risk tolerance will become, and therefore the more likely you are to transition into stable cash investments to preserve your wealth. And preservation and growing your wealth can come from diversifying, spreading your risk amongst different asset classes and sectors, which kind of leads me on to stage 3, which is investment selection. Because once you've determined your asset allocation, it's now time to revisit the different asset classes to choose specific investments. And this is where you can become absolutely overwhelmed with choice. Thousands of stocks to buy, hundreds of different ETFs to potentially invest into. Where exactly do you start? Well, you can use things like stock screeners in order to help filter out some of the noise, based on pre-specified requirements on stock valuations that you've calculated, which if you're not sure about, I'll leave a useful link down in the description below for you to check out. Or if you really want to keep things simple and hands-off, you could go down the ETF route and see what's available. Cornerstone of my portfolio is based on one single ETF called the Vanguard VUSA S&P 500, made up of the top 500 companies in the United States of America, and has an inflationary adjusted return on investment of about 7% per year. And what I like about the S&P 500 more specifically is that the S&P 500 as an index is reviewed every quarter, meaning the poor performing companies drop out of the index and better and up-and-coming companies get entered into the index, meaning that you get exposure and access to the top 500 companies in the United States at any single given point in time. It's even what the likes of Warren Buffett recommends that the average investor should just invest in.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund.
But ultimately, it's up to you guys to do your research and go on to invest into individual companies, industries, or even whole countries that you think will perform the best over time. But before you press on and buy your first investment, it's hugely important to consider the tax implications. Because let's be honest, nobody wants to pay more tax than they already do. Tax rules are different for different countries. But over here in the UK, we have something called a Stocks and Shares ISA that allows every UK resident to invest up to £20,000 per year absolutely tax-free, meaning any capital gains that you make from your investments are yours to keep. So at this point, hopefully you've got some of your goals written down, your risk tolerance identified, your asset allocation chosen, and your investments selected, meaning all you need to do now is find the right broker. Now there is one final super important point to execute stage 4 of building a profitable investment portfolio, and that's ongoing governance. Sounds boring, but it's so important to be well informed and continue to be informed about the investments that you've made. Because the reality is financial markets change and market trends change too, which can either positively or negatively affect your investment portfolio. I have first-hand experience of this in the past 24 months or so, as the market kind of transitioned from having an appetite towards high growth stocks then into kind of this high inflationary, higher interest rate environment where all of a sudden there was absolutely no appetite to hold high growth stocks within an investment portfolio. This resulted in me taking a little bit of a loss on a stock called Unity Software of £585, which I shared recently in a portfolio update. But looking at this from a slightly different angle, it's also just as important not to make kind of hasty decisions based on short-term changes in the market. If you sold everything back in 2022 because the market was performing badly, well, you would have missed out on all of the gains in 2023. And that's actually one of the secrets as to why I've done so well this year. It's because I continued to invest regularly whilst the market was down, allowing me to reduce my average cost basis. And now with the market recovering, I've massively been able to capitalize. So if you follow this 4-step plan into 2024 and continue to learn how financial markets work and how to invest, then you certainly won't go far wrong. I've been investing for about 8 years now and I'm learning all the time. And I do have plans to grow my total investment portfolio value to well over £100,000 next year. So if you want to see how I'm going to plan to do that, then be sure to subscribe to the channel. But before you go, if you want to know why I have this specific goal, it's because your investment portfolio actually explodes after you hit £100,000. And if you want to know a little bit more about why, then be sure to click on this video next. And with that being said, I'll see you over in the next one.